Can you guys hear me? Jill, can you hear me okay?
Hi, Patrick. Yeah, we're still getting everybody in the room. I can hear you.
You can't see me, can you?
Okay, I'm ready to do roll call. Mark Linity.
Here.
Justin Campbell. Alec Dowell.
Present.
Brent Myers. Art Leary.
Present.
We have quorum. Given that we do not have our chairperson, do you want to nominate someone for the chairperson for this meeting? Alec,
Yes, ma'am. I'll go ahead and
Okay.
do that.
all right. The agenda is up on the board, then, so it's approval of minutes.
All right. First line item on the agenda is the approval of the minutes. Linity motions to approve.
Second.
All in favor, say aye.
Aye.
Aye. All right. Next up on the agenda, the experience study from the prior meeting featuring Patrick Dolan from Foster and Foster.
Yeah, can you guys hear me okay?
Yes, sir.
Okay, well, the last, a couple of meetings ago, I proposed doing an experience study. You're supposed to do one every 5 years, and it's been 5 years, where we look at the actual experience in the plan, and then we, relative to our assumptions, and then we recommend assumption changes going forward to the board. And then we outline the impact of those assumption changes on the funding requirements. And our fee would be $7,500. And the board had kind of wanted to wait until the city did the salary survey study that they were working on. And so that's why we're here. Hopefully the board can approve the experience study now.
Does anybody from the board have any questions for Mr. Patrick? He did. Personally, Mr. Patrick, I would like all members of the board to be present before we motion this into action. Unless anybody else has any other comments in that regard. But I know we're still missing one of our members this morning. So
Well, and really by the time, I would probably present the study at your March meeting. And you probably wouldn't make any changes to the 2021 report anyway. So that's fine if you want to, table it one more meeting, and then I should be there at your March meeting, and then we can talk about it one last time.
that sounds like a good idea, sir. We'll just go ahead and do that. We'll push it back one more meeting. Hopefully we can have all board members present and we can make a motion at that time.
Sounds good. Well, do you guys need me for anything else in this meeting? Otherwise, I'll sign off.
No, sir, not today. Thank you, sir.
All right, have a good day. Have a good, happy holidays.
Happy holidays. All right, next up on the agenda today is the Sawgrass Asset Management Report from Greg Gosh.
Want me up here or over here?
Wherever you're comfortable.
Well, good morning. 14 days. I got it. I've got a loud voice. I don't want to break your eardrums here. But for the record, my name is Greg Gosh, Client Services Manager for Sawgrass Asset Management. We manage fixed income for you. And I'm going to be somewhat brief, although Burgess will not believe that. But we made a change here earlier this year where we took your fixed income out of a separate account situation and put you in the CIT. And because of that change, there was a little bit of disruption that became advantageous for your plan, we actually refunded some money back because the way the fixed income market was moving in those weeks, that transfer cost the plan some money. So we refunded that money thinking it was the right thing to do. And it was the right thing to do. So also the performance, which will, starting next time I'm here, will be put out, will be mixed together with your former performance from when you had a separate account, is separated out here today. So if you look at page 9 with me, you see quarter to date, 1 year, 3 year, 5 year, and then most importantly, your inception number on page 9. And then you see net of fees at the bottom. Now your fees have dropped from what were 40 basis points down to 29 with the CIT. So that's something also to note. So on page 10, if you look at your total return and you see these numbers, and Burgess is going to talk about this, quarter to date, 6 basis points positive versus the aggregate 5 basis points. So that kind of leads me into what's happening. Tomorrow we have the Fed meeting. Take your bets on how much they're going to telegraph or announce at the Federal Reserve, Mr. Powell, on the tapering of the bond buying, the bond purchasing and different ETFs. That's already slowed down. But how is that going to impact the fixed income market? Well, and how quickly are interest rates going to change? That's the big question. And how is that going to affect the equities markets and the bond markets? There's a lot of different opinions on there. A lot of it depends on the speed that they do it. But there's also now questions whether this Omicron variant and inflation have possibly, and the employment picture, which is kind of flattened here the last couple of months, whether that's going to slow down their appetite for getting back to more of a normal and less stimulative type of situation. So we'll find out some things tomorrow. Possibly, we may not, they may just telegraph things. But right now, lately, we have added slightly to corporate bonds. We've been hesitant to do that because of how thin the difference between treasuries and corporates were. The spreads were very tight. We thought they were a lot of them were overvalued, but there's been some new issues that we think have a good pricing that we've added, but we're still lighter than what we normally are for corporate bonds. But we remain short in duration. We expect higher rates next year. And but we think the Fed's going to be more patient in what the market is pricing in. So the long-term rate should increase more and underperform the short maturities here in the next 12 to 18 months. So we're going to have to find out what happens tomorrow. But a lot, we've had so much government intervention here the last, I don't know, really, if you go back to 2008, but specifically since the COVID phenomenon hit, we have taken on more debt in that period of time between last March and now than we did throughout the whole QEs of the financial crisis. So it's been pretty significant. And that's going to have a longer term impact on US debt. And it's going to have a long-term impact on the equities markets, because when you start taking out the stimulus, all of a sudden things look very expensive and earnings start to matter more. And it's going to see the whole psychology of purchasing stocks, where, like we've seen in the last year with the meme stocks and people buying all these companies that don't make any money, like Rivian, who hasn't made a truck yet. Their stock was up a couple 100% in a matter of a week on their IPO. Those things tend to dissipate. It becomes more of, if you're going to go buy a business, you want to make sure it's profitable. They make money. You don't want to pay too much for it. Well, that's gone out the window here the last really 10 years. So bonds have kind of suffered in that matter, because when risk is on, people want to go to junk bonds. They want to go to stocks and international and go things. And the herd's been going that way now for about 10 years. So we're going to see what happens when that pendulum starts to swing back the other way towards a more fundamental market, and that will impact both bonds and stocks. Any questions for me?
I have a question.
Yes, sir.
Testing. You get it? Do you have that, where's that slide in your book that shows the scenarios? Rates go up, rates go down, impact on the net asset
Page
value.
29.
Why don't you give them a sense of what may happen based on that model, please?
All right, if you look at the consensus forecast on, which is column 13, the last column. So rates go up and down the spectrum, but the rates go up not a lot, 24 basis points all the way to about 40 on the 10-year. Your return would be 20 basis points for the year, next 12 months. The index would be down 39, so we'd be protecting, but you're only going up 20 basis points. And if you go up and down the spectrum of all these different scenarios, if the Treasury, if interest rates went up 100 basis points next year, which we feel like they could go up between 50 and 100 next year, depending on the veracity of what the Fed does and the reaction of the markets, you're looking at pretty much 4 and 5. So you're looking at negative returns on your bonds if there's any kind of increase in rates next year, which we believe there will be, probably more towards the second half of the year, but you're looking at negative returns. So what's important is the alternatives that you guys have chosen through the years to take some pressure off your fixed income. Now, fixed income is there for a reason. If we have a stock market that goes down 30, 40%, this is going to help you. But right now, what we've seen for the last 10 years, you're looking at a negative. And if we just kind of keep going the way, the train we're going now, with a little bit of interest rates with rising, you're looking at negative return on your bonds. Now, I don't know what your fiscal year returns were, but I'm guessing they were pretty good this past year. Everybody was solidly in double digits that I've been at meetings with. So I think your question was, what are bonds going to probably do next year?
What would you zero in on the column you think is most likely?
I think most likely is column 4. And that's the Treasury up and down. Now, they never go up and down in unison, but let's just, for the sake of argument here, saying interest rates go up 50 basis points. So right now, short-term rates are basically at 0. If you really look at the big picture, they're negative. Not like Germany, but they are, in all intents and purposes, practicality, they're negative. So scenario 4, you have a negative 73 basis point return with how we're managing your fixed income. The market's going to be down twice that much, negative 143. And then kind of in between the two, 4 and 5. So I would expect maybe a 50 to 75 basis point increase in rates, depending on inflation, employment, and again, how the market, if the market reacts like it did in 2018 with a couple of bumps in federal short-term interest rates, you could see this not happening. But the way it stands right now, I would put my money somewhere between 4 and 5. But if the stock market starts to tank and the economy tanks with it, you could go the other direction. So I don't mean to speak out of both sides of my mouth, but if the stock market starts to sell off because, the vodka is not being poured in the punch bowl anymore at this big party we've been having, you could see scenario 1 or 2 happen, which would be a positive in terms of return, but your stocks would offset that significantly. And so you'd be putting the heat on capital cities going, hey, where do we go now? Like we did back in 08 and early 09. Did that answer your question? And I hate to like not be real specific, but there's a lot of things. There's been so much intervention with the government, with the Federal Reserve, that they had any move they make is going to have a big impact on the markets moving forward. And they're necessary. You can't hold up the markets artificially for as long as we have and not have some kind of ripple effect. So thank you. Any other questions for me?
I don't believe so. Thank you very much, Mr. Gosh.
Thank you, guys. It's good. We appreciate your business. Great working with you, and look forward to seeing you again soon. And thank you.
All right.
You might want to make a motion to accept the report.
We have a motion to accept the report from Mr. Greg Gosh.
Motion to accept his report.
Motion made by Mr. Leary. Seconded by Mr. Leonard. All in favor, say aye.
Aye.
Next up on the agenda, the Capital City Trust Report, Dwayne Madron. Morning.
Also, in terms of company we are approaching.
There we go. We are approaching about $1 billion under management, which is a lot for us. And we recently hired 3 new trust administrators in the past couple months. So we also purchased a strategic wealth management company out of Central Georgia. So those are the changes that have happened at the company. So having said that, I think in front of you, you have a booklet that looks like this. And if you can turn to the inside cover that says policy review, there's a page on, I believe, the first tab that talks about the asset allocation stance. There we go, up on the screen there. So this is as of December 2nd. Currently versus your policy, and this has been the case for a while, I'm overweight in US equities, larger US equities, at the expense of being underweight international, simply because conditions in the US are better than they are across the pond. In terms of a stronger dollar, stronger growth, better economic and governmental conditions. So, and also by being overweight large US companies like Microsoft, Apple, and Amazon, I had to be underweight in something. And I chose convertible bonds simply because I feel like the expected return of large US companies is better than convertible bonds because interest rates are going up slowly. I brought fixed in during the quarter. I moved a little bit of money to Sawgrass, about $100,000, because I was starting to hit my head on the 70% equity cap that your policy has. So instead of holding cash, which pays very little or nothing, I moved some money to Sawgrass, which brought fixed income up to a neutral stance, which is a move that I think it was needed, because rather than sit in cash and earn nothing, at least I can earn some yield from Sawgrass, even though their total return may be negative. I'm earning something rather than earning nothing in cash. So, so bonds are now neutral, even though you might think you want to be underweight bonds. It's difficult to do that and hold, because if I'm underweight bonds, I'm going to be holding cash, which I would rather not do. So any questions on the asset allocation stance? If not, we can go on to account performance.
I just have one question real quick. So in regards to the returns being negative, but still having positive, like you said, positive, I guess, because the yield is outweighing the negative return.
Eventually it will.
Eventually it will.
Yeah, because yields are going up and Sawgrass will be reinvesting money into higher yielding bonds, which eventually will be a good thing.
Yes, sir.
I'd rather not try and time it. I'd rather give the money to Sawgrass and let them take advantage of this rising rate environment next
Okay.
year.
Yes, sir.
Although in the next couple months, that may not happen, but eventually it's going to happen because the Fed is backing out of the bond market. So going on to account performance, you'll see a green pie chart. This is as of 9/30. So this is the equity side. This does not have the Sawgrass returns in it. So for the past year, which is the fiscal year, 28.98%, which is an outstanding return. Equities return 31.42%, bonds 7.65, and those are the convertible bonds and the high yield bonds. They are, but I'll get to that in a minute. And the real estate return 31.8. Year to date, which is the same number as the 1 year because this report is a fiscal year report. So the year to date is the fiscal year to date. And the latest quarter, which is why we're here today, the third quarter was negative. And the reason for that was that in September, there were some investors had some concerns. One was equities were very expensive. Then there was a concern of rising oil prices, stagflation, rising interest rates, and the prospect of Fed Reserve, coming out and making a statement that was undesirable. So September, there was some news that caused investors to back off of equities. And so September was down about 4 to 5%. However, in October, when earnings reports came out, all that turned around. And October became the best month in the equity market for 2021. So we're off to a good start. And you can see that on the next page. I have returns through October. So year to date is the fiscal year to date. The equity side is up 4.97 because equities were up 5.32 in your equities were up 5.32 in October. Bonds were flat at 0. Real estate was up 7 because it tends to behave like an equity. Off to a good start for the new fiscal year. Yes. So then the next page over is the asset allocation, which is as of December 2nd. And this says on equities, it says 56.86. That includes the convertible bonds. If you add the real estate to it and the infrastructure program, then you're closer to 66 as the policy defines equity, still below the 70%. I don't like to get above 68. And when I get there, I either move in the cash or I give some money to Sawgrass. So it's a moderate growth portfolio. It's on the borderline of being aggressive, but it is not aggressive. Your bonds are there at 30% weight to cushion you against drops in the stock market, which of course happened in September, and bonds outperformed stocks. The other pages are a listing of the mutual funds that we use: small cap, mid cap, large cap, international, high yield bonds. You'll see the Sawgrass Collective Investment Trust at a value of $2,693,000. And so, in sum, next year is going to be interesting because as interest rates rise, it tends to hurt growth companies because their earnings are far out into the future. However, many companies that we use are large and they have diversified products and diversified revenue streams, and they're able to weather the inflation and the rising rates. The ones that really get hurt are the ones like Rivian that have no earnings to speak of, and whose earnings are forecasted far into the future. Those aggressive growth companies will get hurt a lot when rates jump. But you're spread out through growth, core, and value, which is a mixture of, let's say, healthcare, financials, energy, which has benefited from rising oil prices. You do have Amazon and Google, which are growth companies, but they're solid growth companies. They're not like a Twitter or a Twilio or any of these companies that barely make money. So I'm optimistic that next year will be decent. It won't be like this year. Perhaps we'll earn 12, That would be my best educated guess, is 12 instead of 28 on the equity side. So it should be an interesting year as rates go up and the Federal Reserve quits propping up the economy, which is what they've been doing. So we're going to take the training wheels off, and next year we're going to see how the economy does. So the one last thing I would like to bring up is that every 3 years, we like to have a new investment policy re-signed. However, I was talking to Jill, and in your case, if you will reaffirm your investment policy, and we can include that in the minutes, that will suffice for the bank auditors. It might be a motion to reaffirm the policy as it stands. You can do that now, or you can do it later. That would be nice.
I would recommend you reaffirm the policy.
All right. Motion to reaffirm the policy. Second. All in favor, aye? Aye.
Okay, thank you.
Thank you, sir.
You don't want me to stand over there? No
No,
one can
for-
see
no.
me?
Yeah, you can see us better.
How about if I stand up on the podium?
Perfect. No further questions before we move on for Mr. Dwayne Madron? Anyone? No? Okay. Motion to accept the Capital City Trust report.
Second.
All in favor, aye? Next up on the agenda today is the BCA report from Burgess Chambers.
Good morning, everybody.
Morning.
So everything, big picture, everything looks good. You have a 7.5% budgeted return expectation that Patrick uses in his model. And any time period you look at, quite frankly, you've exceeded that. You've beaten that return expectation. And that's good. It's good for the plan and it's good for the city. Let's go to page 1. Mitchell and I put this together. You may find it of interest. But the supply chain quandary has really affected a lot of things. It's affected housing prices, commercial real estate valuations, whether or not you're going to get the windows in on time when you're on the remodel. Across the board, there are shortages. And quite frankly, this began when different parts of the supply chain, logistics companies, were so frightened by the COVID news in the first quarter of last year, they laid off a lot of people. And because they saw this sudden drop in economic activity, and then when they realized they had miscalculated, they couldn't get people to come back to work. So there were incentives for people not to go back to work. And to make matters worse, what do people do when they're bored and they're at home? They shop. And so there was a spike in consumer demand. Retail sales went through the roof. And a lot of that stuff comes from overseas, from the West Coast. So to make matters worse. So now they're trying to clear the river of all these logs. And, it's going to take some time. But in the meanwhile, the Biden administration issued an executive order from top to bottom to look at everything to try to figure out how to prevent this in the future. But I don't think you can prevent human activity. We make personal choices. I don't know how you regulate that, but anyway, that I thought you might find this interesting. If you go to page 11, or actually page 12, we sometimes don't cover this, but I thought it'd be meaningful to cover it. Within the fixed income strategy, which is 2.8 million, it's broken down into two pieces, a high quality core fixed income program that Greg talked about, 2.5 million. And then there's roughly 300,000 in a high yield piece. It's an index. This decision was made more than 5 years ago, and it's actually added performance. And if you look at the 5, the 3, the 1, over all these time periods here, high yield has outperformed the high quality portfolio. But remember, high yield means low quality bonds where companies can go bust. But the reason why we thought this was a good idea was because in periods when the economy is expanding and is getting stronger, high yield does very well. And you can even see the 1 year period, 8.2%, even though it's roughly 1/10 of the bond program, it was enough to move the needle. So the 1 year return for fixed income was minus 0.3 as opposed to 1.3 minus. And even for the quarter, 0.9 was enough to push the overall return up to 0.2 from 0.1. So it's added some value over time. You can even see the 5 year 3.7 versus 3.3 because of the impact of high yield. On page 11, I should point out a couple things. The convertibles, if you look at the convertible performance for the 5 year period, it outperformed domestic equity 17.8 versus 15.8. You see that? 3 year 21.4 versus 14.6, and the 1 year 27, it trailed domestic equity. Last year, convertibles did very well. One example was because of the Tesla exposure that the index had. That was one of the reasons why it did so well last year. But you can see that this asset class, even though it represents only about a little less than 400,000, has had a meaningful, favorable impact. To Dwayne's credit, the underweight to international, it's modest, but it's there, is helping you right now because international is getting beat up pretty good. This product has about a 25% allocation to emerging markets. Emerging markets year to date are negative, primarily because of China. And I should mention that China's big drag right now is real estate. They have a major collapse. Probably their top 10 real estate companies in China are bankrupt, basically. They're insolvent. On page 4 are summary remarks. As Dwayne pointed out, you have a 65% target weighting to equities. You have a maximum of 70. This is clearly not aggressive. It's a back-tested and proven allocation because of the long-term results have bettered the actual assumption rate. The 1 year number of 19.2 net, very close to the model. We have some plans that did a little bit better, but they had a higher target allocation to equities. The 3 year number, impressive, top 37th percentile. 5 year, similar, top 39th. These are important figures to understand because when you rank in the top 39th percentile, you're above the median, which is 50. 25 would be the top quartile. So anywhere between the 50th and the first quartile with this type of allocation, I think is quite impressive. The 10-year number, where I think speaks for itself. You earn just shy of $7 million, 9.7. For about half of the last 10 years, the budgeted return was about 8%. top 41st percentile. I went to New York in September for the 20th anniversary. 9/11. I did have a chance to visit Cohen and Steers and to talk to them about infrastructure. Their offices were dark. Nobody was there. And I asked them, when was the last time a consultant came up here to visit you guys and see what's going on? March 2020. So I had to get these guys out of bed and shaving and everything to meet me in New York City. They're all working out of their homes in Connecticut or wherever. I skipped over the Reits. Let's go back into this and look at the Reits. The Reits have just been fabulous. You see them on page 12. 33.4% for the year, your fiscal year. And actually it's 32. I guess we rolled up. That's right. We made a change into a better, a lower fee REIT product, index product. But year to date, since January 1, the REITs are up about 29%. This shocks everybody. Do you remember early in last year when everybody's worried about the malls and the office buildings going under and everybody changing forever their lifestyles? Well, people are back in the malls. Simon Properties, the largest mall owner operator, reports gangbuster earnings. People want to go out and shop again. So the vacancies are improving there. And in the office space, because of the rise in replacement costs and labor costs and environmental costs and legal costs, existing commercial office buildings in the primary metro areas around the country have witnessed increasing values. And that's the major lift. You think about it, if the REITs, the income off of those REITs over the last year was probably somewhere around 3.5%, 4%, maybe 4.5%. So to get a 32% return, that the bulk of its appreciation, right? 27% of that. Final page. Sorry, I spoke so long. Page 7, but I only get here 4 times a year. 10 years ago, the program was 5.3 million. The program experienced net outflows over the last 10 years of about 2.4 million, and that's defined as if the city's contribution is a positive, the deductions out of your payroll, that's a positive into the plan. The premium tax money, Chapter 175, that's a positive, and then the negative is the flows out to pay expenses. But you can see your earnings of 6.9 million, or roughly almost 3 times, say 2.5 times the outflow. So that looks good to me. That's all I have today. Any questions?
Any questions from any of the members on the board? No. Motion to accept the BCA report.
Thank you.
Motion to accept the report.
All in favor, say aye.
Aye.
Thank you, Mr. Chambers.
Yes, sir.
Next up on the agenda today, Klausner, Kaufman, Jensen, Anna Parrish.
Good morning, everybody.
Good morning.
I have nothing to add for my report unless anybody has questions for me.
Fair enough. Anybody have any questions for Mrs. Parrish?
I just have one. Did we do the return declaration letter?
Not that I am aware of.
Jill, we do that every year. Yeah. Did we provide it to you yet?
I don't think I've received that from Jill.
Okay, I'll make sure that gets done.
Okay. And I'll confirm with her that I've received it.
And that letter is provided to the state of Florida Division of Retirement as well, right?
Yes, I believe it is.
Is Patrick still online? Okay. I
It
think we're
doesn't
still
appear
at-
that he is.
We're still at 7.5%. Okay, that's all I needed.
Thank you, Ms. Parrish. I believe there's no other questions at this time. Motion to accept Klausner, Kaufman, Jensen.
Motion.
All right, all in favor, say aye.
Aye.
Motion made to accept the report. All right. Next up on the agenda is the meeting schedule for the year of 2022.
Second.
All in favor, say aye.
Aye.
Aye. All right. Motion made to accept the scheduled 2022. Next agenda item is the quarterly expenditure report. Did everybody receive a copy?
This then is a actual fiscal year report. It goes from October to September. And the summaries on the right-hand side show the actual costs versus the budget, where we stand on those, pension expense. When Burgess was showing you the expenses, in addition to like expenses as far as attorney and everything, the pension expense is also an expense. So every month that you're paying out pension adds up to more than $500,000 there. And that city contribution left in when employee contributions are refunded, that $176,000 is money that the actuary plans on having based on how many people leave employment before they're vested. But this kind of puts a little bit of a number to it for you.
Any questions from the board regarding the expenditure report? Any other comments from you, Ms. Kaiser, in regards to this?
No, just to make a motion and approve it.
Motion to accept the expenditure report,
Second.
seconded by Mr. Leary. All in favor, say aye.
Aye.
Next up on the agenda is any comments from the public?
If you, if you wait a minute, I'll find out if anyone's commented.
Yes, ma'am.
Sunny checks on that. Okay, no comment, no public comment.
Yes, ma'am.
On other business, I know that the fire department is having an election for Brent Meyer's position, which ends in January 2022. He's allowed to re-up for that position. So
Yes, ma'am. Motion to adjourn the meeting,
Second.
seconded by Mr. Lear. All in favor, say aye. Aye. Meeting adjourned at 10:52. Thank you.
Thanks, everyone.
He's got acres now. Takes hours. Good to see you. How are you? So you guys want to join us for lunch? Want to join us for lunch?
You ever get to Tallahassee, let me know, I'll show you. Let's do school.
My neighbor across the street.
This is general plan.
Oh, okay. Maybe not.
With the last meeting, I said you get over it. It's all about.
My buddy lives right. Yeah.
Thank you, good job.